Hi, thanks so much for tuning in. You're watching BQ Prime. My name is Alex Matthew, and this is Stocks in Focus. Take a look at the benchmark indices. They're trading higher at this point. The Nifty 50 trading at 18,376 or thereabouts, up about 1/3%. Now, we are, of course, going to focus on the stocks in the news, and joining me to talk to you about those companies is Vinit Bolinjkar, who is the head of research at Ventura Securities. Thanks so much, Vinit, for taking the time. And it's a long list of stocks today for several reasons. And of course, we've got to digest the implications of the results of the assembly elections over the weekend. But let's talk about, in my opinion, the stock of the day, which is Tata Motors at the start. And what a turnaround story for this company, particularly on account of the JLR performance. Of course, the headline is that the revenue is up as much as 35% in the quarter ended March. EBITDA has risen as much as 58%. EBITDA margins are better. But there's also commentary with regard to Jaguar Land Rover's roadmap ahead, and that relates to the debt reduction, that relates to the EV plans that they have. What's your rating of the results and the way forward?
So, none would be happier than, us at Ventura, because we had covered this stock only a couple of months ago at about 410, and the stock is up 25% from our levels as we speak. So it just reinforces our confidence, the results that have come out. And we believe that the company is well on track to deliver a very solid performance over the next 3 years. What we are gung-ho about is the new EV rollout for JLR, as well as the PV business in India. And the domestic CV cycle will continue to play out over the next 2 years. So with all three engines firing strong, we expect, good EBIT margins to come in. The company is guided for 10% EBIT margins in FY26. And, the current 6.5, which has come out in Q4, is well on road to that. But more important is the fact that the company is confident of generating $3 billion of free cash flow. And, this was one of our primary concerns. So with that reinstated, we believe that the CAPEX plans would be well funded, largely through internal accruals and some borrowing if required.
Okay, so that's interesting. And a large number of brokerages have raised their target prices for this counter. My only question is, there are headwinds in the way of key markets slowing down overall, right? There are question marks about the US. There are question marks about Europe. They, of course, have quite a significant presence, Jaguar Land Rover, in China. Is that something of a concern, or do you think that's par for the course? It's in the price right now.
So I think, as although there is a lot of concern over the growth in these markets, but the bigger concern for these developed markets is the global climate bond, and the funding which is being meted out by these governments is going to support the EV growth going ahead. So I believe that this is one of those pockets in the global markets which will outperform the slowdown in the markets.
Is it a buy in your opinion?
Absolutely.
Okay,
so we have a target of 700 plus.
Wow.
But our targets are more, they're very. We try to give an investor's perspective to our targets. So we see a price of 700 over the next couple of years.
Okay, fantastic. And that's higher, I might add, than a lot of people have right now. So the next two counters, Adani Enterprises as well as Adani Transmission, both of them announcing fundraising plans over the weekend. This was expected, 12,500 crore rupees through a QIP by Adani Enterprises, 8,500 crore rupees by Adani Transmission, and Adani Transmission among the Adani Group stocks that has now moved out of the ASM. What's your reaction to this latest update? The stocks are under a little bit of pressure in trade today.
So, if you leave out the regular movements of these stocks on a daily basis, it is very important for the Adani Group to raise growth capital, because they're in a very, very rapid expansion stream. They are, got very, very aggressive and ambitious plans. So for that, they need this equity infusion. The fact that, for the last 4 months, they had to slow down on their equity infusion meant that the group had to resort to alternate methods of, shoring up and consolidating their performance. So while they've consolidated their balance sheet a bit and made it more healthier, raising this this 21,000 crores for these two companies is obviously coming under the effect that they would have sounded the markets and seen the appetite for the fundraise, right? So since they've announced the fundraise, I believe that is a stepping stone to getting the growth capital. And these two are the ventures which need most of the capital. So, green hydrogen, they've committed to $70 billion of investments. So that money coming, part of it going into developing the backward integration into manufacturing of the solar modules and the wind turbines. And, partly funding the airports business. So this is very strong music for our ears, and we believe that this should play out very well. Additionally, if you look at the transmission business, India has a very ambitious plan of expanding their power generation capacity from 400 gigawatts to about 900 by 2030. Now, this is entirely largely going to come from new renewable sources, so you cannot use the existing lines. So you will perforce need a new transmission network. And that is one opportunity where Adani, if they get the growth capital, they can fund that growth. Funding for that on the debt side would not be a problem because they would be regulated assets, and the funding would come in through the regulation mechanisms of the Indian PFCs and RECs of the world.
Okay.
So I believe getting the growth capital is good for these stocks, and we will be raising our targets on these once we.
Okay. So could you give us a sense of what the call is on these two counters and what are the targets here?
So, on Adani Enterprises, our target was around 3,000. And if you take a haircut for all the other businesses, we were saying it would be around 2,400. But now we will have to raise it substantially higher than this. We're still a work in progress.
Understood. Okay. So that's also quite a significant upside from the current market price for Adani Enterprises in particular. HPCL is the next counter that I'd like to focus on. And of course, the Q4 results were good, better than expected. And crude oil prices have been on the downturn in the recent past, Brent hovering around that $70 per barrel mark, which is positive for this counter. But there's also an update in the form of the setting up or the incorporation of a wholly owned subsidiary to essentially consolidate all of its green and emerging business opportunities there. And also the idea of the roadmap for unlocking value in its lubricant business. These are also, I think, positives. The stock has reacted well. What's your reading of the results and these other developments?
So the results beat our expectations. They were very strong. And we believe that the marketing margins are going to play out much better going ahead. Refining margins have also been looking up. And, if you take into consideration the entire global slowdown, I think they're in a very sweet spot in terms of managing their refining margins, given that the volatility is much under control. With regards to, consolidating their green assets and looking to diversify their lubricants business is a very, very strong move. Because, if you see the lubricants business has been not that profitable when you can compare it with Castrol or with Gulf Oil. Now, with this kind of thrust and focus coming in on the lubricants business, they'll be more answerable to shareholders. And I believe that there could be some value unlocking happening out there. Second is, if you look at the green assets that are there, it's going to, India's requirement of green energy is going to be very, very large. And there are very few players who have got deep pockets to invest that kind of money. So I believe that, if you take into consideration NTPC, Oil India, HPCL, BPCL and ONGC, these counters which were, kind of the pariah of the stock market should see renewed interest from marquee investors as their green plans become more, see the light of day and, the numbers start trickling.
Okay, what's the call on HPCL then? Would you still say that
definitely
it's a buy?
Buy for the short term? I think a target of 30-35% plus on a 1.5 years time frame seems to be a very, very conservative price target.
Okay. All right. Moving on to Naveen Fluorine, and it's not a very sharp stock reaction, though the results have been absolutely stellar in this case, Vinit. And I'm reading off the key highlights here. The revenue's up as much as 70%. Gross margins are up as much as 740 basis points. EBITDA margins up as much as 589 basis points at 28.9%. PAT is up as much as 80% to 136.4. What is your reading? One, significantly better than expected, I think, for this counter, but it's not really seeing a spurt in the stock price. Would it still be a buy in your book?
See, the price already discounts all the positives that have come in. So, while the perspective of, we expect 25 to 30% growth playing out over the next 2-3 years, driven by their focus on agrochemicals, specialty chemicals, and their new R32 plant being commissioned. I think that will be also a bonanza for the company, and they're very, very confident of meeting margins despite the fact that there are a lot of players setting up capacity. And the entire body language of the company has been that we are moving more into complex chemistries, moving away from the pharma side, and getting into the businesses where it's not easy to replicate the business model. So that should help sustain gross margins. That should help sustain EBITDA. And with the capacities coming up, you have a compounder there.
5%.
So my view would be to actually, buy the stock on dips because much of the growth for FY24 has been factored in. But the big numbers will come in from 25 and 26.
Interesting. Yeah, pointing out that it's in the price, it's gained about 5% over the last 1 month or so. So that is something that has been pointed out as well. Moving to the real estate space and DLF, also promising results from DLF. But I think what is more interesting is the update on the net debt reduction, as much as significant. In fact, it's come down to 720 crore rupees from 2090 crore rupees, and that's just quarter on quarter. And there's also quite a bullish pre-sales guidance from the company. This is at a time, of course, when the macro environment is not really conducive, or it's proving to be a little bit of a question mark for real estate companies with the interest rates where they are. What's your reading of these results and the outlook for DLF?
So, if you look at the macro picture, as you mentioned, I think we've peaked in terms of interest rates, and, given the huge base effect of last year, I think we will see a significant fall in the inflationary trends going ahead. And given that, we can see some minor cuts in lending rates happening. With this in mind, and with the kind of debt reduction that we have seen, I think this stock offers significant value. It is one of the most prominent players in the NCR market, and they will continue to be so. And given the focus that India is for global corporations, right, to set a business out here, I think the stock is poised for a big rally from here.
Okay, but then if I were to ask you, between DLF and the other players in the real estate space, would it still stand out as a pick for you?
Yes, definitely. So DLF is one of the high conviction banks.
Okay, and so therefore a buy at this point. Do you have any targets that you can share with us?
We don't have active coverage on the stock, but I believe that we can make sizable money out.
Okay. The next counter, I said Tata Motors is the stock of the day, but going purely by the stock reaction, VST Tillers certainly has a shout out to be among the top today. Of course, 13% higher at this juncture, and that's on the back of its results, which were stellar. You have revenue up as much as for 48%. You have EBITDA margin that's come in at 17%, which is an expansion compared with the previous quarter. And you have PAT that has grown as much as 82% to 40 crore. Is this a counter that you're tracking closely? What are you thinking about in terms of the results? Is this an indication of a very strong growth trend going forward?
So, the management is very conservative in what they speak. And this time around, their commentary has been very, very strong. So they've guided for 40% CAGR growth over the next 3 years. And I'm just waiting to get my money into this counter. So definitely a buy from my side, especially, being agrarian nature. What it says is that, there's a lot of mechanization coming through. And they're also into the lower HP tractor segments. So they're seeing a lot of growth coming through, and I believe that the company will do well in this space.
Okay, interesting. And that's despite you're saying that you're interested in picking up this counter despite the fact that it's seen a significant run up, not just today, but in the recent past?
Yes. So what I expect is that, after this outlier kind of 13-15% higher kind of offtake, it would settle down over the next couple of days, and, you can pick it up
on dips. Okay, Avenue Supermarts. Its results, of course, in focus. Revenue up as much as 20% for the quarter. Gross margins are down 93 bips. You have PAT that's up as much as 8%. Store additions, 18 during the quarter. What are your readings of the headline numbers? And it's not like the stock has not done much over quite a while now. Would you still say that it's a buy, because this is a counter that has traditionally been looked at as expensive? Do you still think that it's expensive given the kind of growth trends that you've seen?
So, what is disappointing is the gross margins that came. It was 50 points lower than historically. And, when your gross margins dip, it is kind of telling that your business model is under pressure. Having said that, they're expanding their retail space at quite a brisk pace. They've added 16% of the total, the total footprint that they have. And I believe that as the economy recovers, they should get their volume mix right. The apparel, general merchandise trade is kind of pulling the margins down because the sales from there are not grown as much. And despite the inflation, they have not been able to, grow their gross margins. So that's a little bit of a concern. But I guess that, their foray into the pharmacy business will be watched very keenly. So for me, this stock is a wait at current levels. Although, we are gung-ho on the management, and we like the company, we like the space, and we think that it's a very under-penetrated market. The landscape of India is theirs for the play because they have perfected their model. But I think for the time being, their model is under pressure, and you should use dips to buy into this stock. And the clear things to track for is improvement in general merchandise sales and tracking the gross margins.
Yeah, there is going to be significant pressure in terms of competition as well, right? A lot of players entering the space, players consolidating as well.
Yes, and what has happened, if you compare with FY19, the offline sales have been kind of not growing as anticipated. So the online boom has been very, very strong. So they will continue to remain under pressure, and we need to track this very closely and see how the model evolves for the company.
Okay. Wait and watch is the call on Avenue Supermarts. Now, to close out this conversation, I was reading an interesting note just this morning about the implications of the results that we saw in Karnataka over the weekend. And the expectation is that over the next 12 months in the run-up to the general elections, you're likely to see both the center as well as several state governments announce plans that are populist in nature. And that could be a positive tailwind for consumer staples. And also the fact that raw material prices have eased off, and that could also prove to be a margin tailwind for these companies. Do you agree with that thesis, that expectation, and which stocks, if any, would you focus on?
So we like Marico and we like Varun Beverages because these are two of the stocks which have shown some significant growth performance compared to the entire staples pack. And we believe that they've got a better chance of doing well. Having said that, we believe that the entire consumer sector should do well, and the populist measures are going to put a lot of money into the hands of the rural public, and we will see strong rural trends play out. So we are quite bullish on this. The worrying factor is, the promises of the freebies that have been announced. If they are larger than the collections of a state, like in the case of Karnataka, it's not good for the state macro, and that can put a lot of pressure on developmental projects going ahead. And also, the only way for them to do this good is the typical Congress formula where they raise prices of petrol and diesel. So, there is no free lunch, as we know, and freebies as a measure for me are a no-no, as in the long term they have a very damaging effect. We've seen what has happened in Punjab, we've seen what has happened in Delhi,
Yeah.
And we have seen what is the status of Himachal Pradesh.
Yeah.
So, it's not a good thing. In the long run, though, in the short run, it might be a lot of adrenaline for the consumer staple stock.
Interesting and fair point there. Thank you so much for taking the time. Always a pleasure speaking with you, Vinit. And viewers, the stocks that we mentioned were quite a few that we've discussed today. As we close out this conversation, the benchmark indices trading at the high point of the day, the Nifty having breached the 18,400 mark. Thanks so much for tuning in. Do stay tuned. Lots more coming up over the course of the day. This is BQ Prime.